This is the Friday, May 25, 2018 version of the Market Plus segment. Joining us now, Sue Martin. Hello, Sue.
Hi there.
I was rude and I apologized during the broadcast, cutting you off when we were just getting going about livestock. Where do you want to pick up? We were talking cattle on feed and placements. Placements off 8% from a year ago at this time. Marketing at 106%. What are you reading in on these cattle markets?
Well, I'm looking at, I talked in the show about cattle on feed 120 days or greater, and the imports of feeders coming in from Canada and Mexico, which, if they continue with the drought up there, will we see that push cattle into the U.S.? I don't think so. I think the underestimation is the death loss that we have seen in cows and calves in Montana, southern Canada, North Dakota, and South Dakota. And I think that we have to keep in mind the heat's not good for cattle up there, and their pastures are probably going to be stressed, and we need to watch that. But the thing I'm watching is beef production. And beef production is, expected to be sharply higher. And in years when it's up sharply, in the first quarter, like this year, we were up drastically from the first quarter of 2017. Then in the second quarter, we're expected to be even greater over the first quarter and the second quarter of 2017. Well, the year of 2006 is a year, there's only like maybe 3 years similar to this, but the year of 2006 was one of those years that really compared. And once again, cattle put a high in February, broke down into April, put a low in, bounced, came back and looked at that low, maybe a little sooner than it did this year. And then we started to move higher. June kind of gradually moved up. The August contract made new highs for the year, for the calendar year, before it was all said and done, and who would have thought? Now, the one thing I don't have is how much pork production and poultry production did we have on hand, but our exports are phenomenal, and domestic demand is phenomenal. And you look at our summer, it feels like it's July and not...
Yeah, we should be celebrating July 4th.
Exactly. And so the grilling season, while it was late getting started, has really taken off and done a good job. So I'm kind of the opinion we've seen our low for the summer. And what I would suggest to producers is that when August cattle get up, if they keep pushing here, and we can get them up around the 105 area and maybe push over that and get up towards 108, and it's going to take us some time to get that done, then I would say buy some puts. Put some puts under you and floor yourself. Maybe you floor it under the recent low, but have some puts and leave that top side open just in case. Because as we go down the road, our numbers are going to keep getting tighter. And that will probably affect us as we roll the year over into the first quarter of next year. So I guess I'm positive, and it's hard to be positive cattle and corn at the same time, but I guess I kind of am.
We will talk about corn in a moment because we have a couple of Twitter and Facebook questions that I want to get into. I unfortunately pinned you down on hogs to give a one-word answer, and you said, not yes or no, but uncoiling. That to me says that's a headed downward. Why?
Well, I'm kind of concerned about hogs. What would really help, and it's been disappointing, that we haven't gotten something closer to done for an agreement with Mexico and NAFTA.
Okay.
Or even Canada. Maybe 40% is what I've seen for a percentage put on it. And that's kind of disappointing because now we may not get anything done till after the presidential election, which is in July. And then it pushes us out, it could even push us into November. That's kind of ironic, but it's a little disappointing because Mexico is a huge importer of U.S. pork and chicken, although they put a ban on U.S. chicken here recently. But I just think even China would start taking a lot more pork, I think. And so it's all about the demand and the usage, although I did notice a chart today on boneless butts or pork butts, and they're higher than 17 and 16 in value at this time, but not as high as they were in 15, but still second highest. I mean, it's kind of interesting how, and I think that goes back to these hot temperatures. It's supposed to be the hottest May on record, and I think that compares to that and of course the grilling season, how it's gotten off to a start.
Or the smoking season with the butts. That's what a lot of people like to do. That's something they will do in their time. Another thing they do is they spend time on social media asking questions. And Ernest in Nebraska sent us one via Facebook, and it kind of ties into what we just discussed when it comes to trade. This one's more specific to China. What commodity, grain, soft, or meats will benefit most from a new, better trade deal with China?
I'm going to say corn. Corn and possibly rice. You know, energy prices have pushed, and therefore cotton maybe, and I'm kind of infringing on cotton a little bit, but that may draw some attention because it takes less to produce cotton clothes than it does synthetics. But I would have to say corn because the picture is so bright. Brazil is using massive amounts of corn for ethanol. They're really on a tangent with ethanol production. But China is gearing that direction. For the month of, well, just take from the 1st of the year to May 1st.
Which is what our chart on the screen says now, December corn.
Chinese imports were up 201.9%, almost 202%. And if you take and look at from just the month of April, Chinese imports were actually 1,200% higher this year than last year. And then you look at what they were importing for sorghum before they put that little kibosh on, or those import duties.
Yeah.
And
the dance.
Yeah, the dance. And so I think that corn is the one that, and the U.S. has a lot of it. What's interesting is foreign production deficits for corn and for beans both, but corn especially, was record high for 17-18, meaning the U.S. out of the picture because we're the supplier. The rest of the world had a record need for corn this marketing year for oat crop. And we see that in our exports. But then as we go into 18-19, according to WASDE, they're forecasting second highest, a little bit of a pullback, which I think is rather interesting.
Yeah.
But in the meantime, I look at soybeans and kind of the same thing. So global demand is very, very good. And I think that's part of this demand-driven market. It's going to keep tugging and pulling. But I think China will be taking corn because they're making an issue about planting beans.
Yeah, that's what I was going to say.
And they want to build their reserves. But have you noticed the new sales seem to be all new crop, which is kind of ironic. They need to be buying new crop. So I would say it's going to be corn because they're going to be putting focus on corn for as they need it. And Brazil one thing in Brazil that happened here just this week was the government fined the major importers, or exporters I should say, like Cargill, Bunge, and some of the smaller ones for, I think, what was it, $21 million fines for buying beans from farmers who had tore up forests in the Cerrado area. And so and they have laws against that. And so fining them, that might just sort of weigh on acres next year. And so what do? Do they plant more beans at the expense of corn? Maybe. We'll see. Slow
that expansion down of what Brazil is supposed to take away from the United States in the world game, which is partially part of Phil's question from Dresden, Ontario, Canada. He's at Agridome in 2018. Sue, can we put the phrase beans in the teens to rest? Or does Mother Nature get the last word?
Oh, you know, I struggle with beans. I can see beans going to $11.19, $11.20. I could see them possibly this year in 2018-19, maybe up towards $12. It would have to really be an evolving thing. And I would suspect if we had beans in the teens, it would have to be in 2019.
Okay.
Calendar
still in
year.
the teens. That's still in the teens, 2018,
yeah, I guess it is.
I'm saying.
But
that's not what it means. I know, trust me. I know
I think it'll work, though. What's interesting is beans are always known to be a speculator's market and also an inflationary type market. So that could change things a little bit, too. Okay,
so that's Phil's question. Tim in Minnesota, $6 wheat guy, he's asking, is wheat in a weather market?
Yes, it is. And you hear more weather talk than you do in demand, so to speak. But I think that'll evolve into that demand. It'll morph into that. I think what's interesting is $6 price. If you take and look at an annual chart, so every bar on that chart is a year. and you take it on KC wheat, a 10-year moving average happens to come in at 606. And ironically, every year we tend to go to that. Now, the last 2 or 3 years we haven't done it. We've been in like a range, so to speak. And I think we're heading towards that. And 606, and then a wave 4 is around 653 for a lead contract. So, and that is based on a lead contract of KC wheat. So I think, yes, I think we're heading back to test that 606 area.
All right, Brian in Illinois at Key Farms 13. With corn hitting old contract highs and corn looking strong in his neck of the woods, do you think corn, December 18, corn, can hit 450 without much of a weather hiccup?
I think it can, because
mostly
it's,
back on what we discussed earlier.
Yes, yes, the demand pull. Yes,
I was listening. I just want to make sure that Brian gets his question answered.
I'm very bullish corn.
He can tell people Sue Martin answered his question on Marketplace, and you can do the same. Watch us on Wednesday, Thursday, and Friday on our social media channels, and we'll help you out how you can participate in the show. All right, 2 more things before I let you go, Sue. Oil and the dollar. Oil was poised to stay above $70 for the week. There's a march to 80. Elaine Cubb last week not buying that. But all of a sudden OPEC says, you know what, we might turn the spigot back on. Is that really what's moving the market?
Well, I think the market had had a nice move to begin with. And 80 is kind of a psychological barrier, just like 70 kind of was. But I also believe that when Saudi Arabia came out and stated that, because they're going to pick up the slack for Venezuela, who is a very good global producer of Brent crude, the best you can get, but they're not paying their people to work, so therefore they're not working, and therefore you don't get it out of the ground. Consequently, I think that that news was just enough, because the U.S. has been pumping like no other and doing a good job. So I think that news was psychological enough to kind of tie a fundamental reason to give it a healthy correction, and we are. And of course, you know, you're at your peak season for usage for driving, and so gasoline prices are high. Higher crude oil prices is kind of detrimental to, you know, manufacturing. So it's probably good to have a healthy little correction here.
And high U.S. dollar as well this week, 5.5-month high.
Yes.
Traditionally, commodities don't go up that high when the dollar goes that high. Why is that theory out the window right now?
Well, mainly because we're in demand-driven markets. And one thing quickly on China, and I might have mentioned this before, but China, Xi Jinping comes from agriculture.
Yeah.
That's his background.
Right.
And, you know, recently, in the past year, I think it was, they got the laws changed to where he might be able to stay in
for a long time.
A long time. He has an endeavor or an ambition, a goal to eradicate poverty amongst all the people in China. 36% of the people in China live on $5 a day. And I think about 43 million, that's about 493 million people. And I think around 43 million people actually live on 95 cents a day. And his goal is by 2020, ironically 2020, but I think that's part of those 5-year plans they have, and that's how they keep arriving at 2020. So he's already into this mission. And to do that, that's going to take a lot of food. It's just going to command a lot of everything, but especially food. And, you know, I just think that we cannot underestimate what that endeavor is going to mean. And they're also talking about doing away with, first they had only 1 child per family, then they moved to 2 children per family. Now they're talking about doing away with that. And it's because the less mouths you have to feed, unfortunately, your economies don't do quite so well. So they need more people to work and to
have a market.
Yes, to have a market. There's another thing we're not paying attention to is India. India has a mission as well, that they're going to put electricity, their electrical grid is going to hit every village in the whole country. That is huge, and that means more food as well. So, you know, when I look at the dollar going up, you know, first off, I think the dollar moving higher is probably temporary. I don't think it's a long-term thing, but it has been doing quite well, which to some degree is kind of helping Argentina and Brazil.
Right, that's
you know,
right.
to some degree. So And also probably helping some of these other countries do their exporting, compete against us. But on the same token, I don't think it's a long-term situation.
All right, very good. Sue Martin, now we can let you enjoy your holiday weekend. Thank you so much for being here.
Thank you for having me.
Good to have you here. And next week, not next year, she'll be back before next year. We do want to thank you for watching, and we do want to let you know that next week, Delaney Howell will return. Yes, she will be back from her academic endeavor that she's doing. We're also going to have Darren Newsom here, and we're going to talk about the Canadian dairy industry and how it manages to stay in the black. So for Sue Martin and the rest of the crew here at Market to Market, have a safe and great holiday weekend, and we'll see you next time here for Market to Market.